everybody. Happy July. It's Ian Beamer with Guaranteed Rate. Hope everybody's doing well. We're halfway through 2023, so a lot to look forward to. We did just get consumer price index numbers on July 12th, just about 2 weeks ago. And those consumer price index numbers reflected the fact that inflation is slowing down tremendously. So we had peaked around November of 2022, a little above 8%. And currently we're sitting at just 3% year over year for the consumer price index number, which was down from 3.9% for the May number. So the Fed's target, again, was to get inflation down to about 2%, 2.5%. So we're close. We're definitely headed that direction. We're headed that direction very, very quickly. The Fed had previously taken a pause in June and not touched interest rates, but did say that they plan on 2 more rate hikes in 2023. So we're expecting the first of those 2 to happen at this next meeting here next week in July. And we do expect the Fed to go ahead and raise interest rates 1/4 point at that meeting. The Fed tries to tend not to surprise anyone. They don't want to do anything drastic. So if they set expectations that they're going to raise interest rates, they will most likely go ahead and do that. They don't like to make any sudden movements, but we'll see what they say in the remarks following the meeting about a second interest rate hike, because I'm not sure that that's going to happen. Consumer price index reflects inflation is down to 3%. I would guess that's going to continue downwards. So the Fed's rate hikes have done what they aim to do. They've lowered inflation. Seems to me that we were getting inflation under control. So the Fed may sit tight for the rest of the year, and we may even see some rate cuts. The only thing that may stave off rate decreases is the fact that unemployment rates are still so very low. In other news, we are coming into an election year in 2024. So I did go ahead and look at the average 30-year fixed interest rates on Freddie Mac's website for the last 20 years. And I looked at the average interest rates for the years preceding elections, and then average interest rates for the 30-year fixed the year of an election. And I noticed a little pattern. The average interest rate during an election year is about 0.4 point lower, about 0.41% lower than the average interest rate the preceding year. So you might call that a coincidence. I'm not sure that's the case, because if you think about it, a lot of investors will perhaps take some money out of the market. They're not sure what the new lawmakers are going to do as far as policy. Are they going to invest in infrastructure? Are they going to loosen up banking? Are they going to, are they going to go green? Are they going to give incentives for renewable energy, etc.? So a lot can change, and that's going to play a big role in where investors want to put their money. So a lot of investors take their money out of the stock market. When you take your money out of the stock market, typically you're going to put that money somewhere. That means putting the money into bonds, typically. And if you put your money into bonds, that increases the demand for bonds and means the yield or interest rate on those bonds can come down. So that's my macroeconomics lesson. The third reason I think interest rates may fall next year is because, again, we've mentioned this before, the current margin between the 10-year U.S. Treasury bond and the 30-year fixed interest rate is over 3%. Traditionally, prior to COVID, prior to 2020, the typical margin between the 10-year U.S. Treasury bond and the 30-year fixed interest rate is about 1.72%. So even if bonds don't move, as the economy kind of returns to normal, as this quantitative easing kind of phases out and those treasury bonds and mortgage-backed securities kind of start to slowly come off the books and expire, we're going to return to a more normal market, and that margin should narrow once again down to that 1.72. So for those 3 reasons, I do believe interest rates will dip. as far as what's going to happen to home prices, obviously demand is outpacing, demand to purchase is outpacing the supply. So not a lot of sellers are willing to part with their record low interest rates that they secured during the COVID era. You know, we had interest rates in the threes. We even touched twos for extremely well qualified buyers, and that's hard to part with. I think slowly this will subside. You can only put off moving for so long. If you need to move for work purposes, or you've got an expanding family, or you just simply don't need the the 5-bedroom house in the burbs anymore. Maybe you need something smaller. You're an empty nester. You can put that off for a while, but eventually you're going to have to make that move. So we should see inventory slowly creep back to a more normal pace. And with the interest rates dropping, if and when they drop, I would certainly think demand will increase as well. So increased demand obviously means increased prices. So I do expect homes to continue to appreciate. So the last thing I wanted to cover this month of July, a lot of you have seen my social media posts, maybe gotten an email or two from me about the Daily Herald Reader's Choice. The results came out just this past Wednesday on the 19th, and I was honored to be even nominated for the Reader's Choice Best Mortgage Lender of 2023. But I had apparently gone ahead and achieved that victory. So I was voted best lender in the Reader's Choice Daily Herald 2023 poll. So I'm honored. That's a huge. I'm humbled. I was not expecting that at all. So thank you so much for those of you that nominated me. Thank you so much for those of you that voted for me. Please DM me with any questions. Please reach out. I'd love to help you. I'd love to answer your questions. Look forward to hearing from you. Have a great July, and I will see you shortly. Thanks so much. Appreciate you checking this out. Bye-bye.